6 stocks to buy when the stock market crashes. Hey guys, welcome back to Explore. Today we will talk about 6 stocks to buy when the stock market crashes. Let's head into it. Number 6. CrowdStrike Holdings. You know what doesn't change one iota when the market crashes? The demand for cybersecurity solutions. That's why at a discount you can get a cybersecurity stock CrowdStrike Holdings and ASDAQ0WD should be considered a blessing. CrowdStrike's cloud-native Falcon platform is its superstar. It oversees approximately 6 trillion events weekly and uses artificial intelligence to become more efficient at identifying and responding to threats over time. Because Falcon was built in the cloud, it's usually nimbler than on-premises security solutions, and more cost-effective as well. CrowdStrike's operating results clearly showed its customers love the product. It's retaining 98% of its clients, and 64% of its customers purchased 4 or more cloud module subscriptions in the most recent quarter. For some context, 4 years ago, only 9% of its clients had 4 or more cloud module subscriptions. CrowdStrike is a no-brainer buy and weakness. Number 5. Home Depot. If brand name stocks are more your thing, a stock market crash or steep correction has historically always been a smart time to load up your cart with shares of do-it-yourself home improvement chain Home Depot. The great thing about Home Depot is that it can play both sides of the fence. If the US economy is firing on all cylinders, there is a good chance sales to commercial clients and contractors will be strong. Comparatively, when economic uncertainty becomes an issue, we've often witnessed homeowners become Home Depot's driving force via remodels and projects. The company is surprisingly well hedged for virtually all economic scenarios. Investors should also know that Home Depot has invested aggressively in digitalization. Though brick-and-mortar remains the core sales driver, Home Depot has seen a big uptick in digital sales over the past couple of years. The seamless integration of the physical and digital experience should help it navigate any near-term market turbulence. Number 4. NextEra Energy. Another defensive stock that can be confidently both hand over first during a stock market crash or a steep short-term decline is electric utility NextEra Energy. Most utility stocks are a slow-growing business that rely on the predictability of demand for those services. This is what makes them solid dividend stocks and a good bet to outpace the prevailing US inflation rate more years than not. What makes NextEra so special is its focus on alternative energy. NextEra is putting between $5 billion and $55 billion to work on predominantly green energy projects between 2020 and 2022, and is a leading utility by solar and wind capacity in the country. Leaning on renewable energy has driven down electric generation costs and pushed the company's growth rate to the high single digits for more than a decade. Keep in mind that NextEra's traditional utility operations, i.e., those not powered by wind or solar, are regulated. Though the company can't pass along price hikes whenever it wants to, it has no exposure to potentially volatile wholesale electricity pricing. This is a highly predictable and profitable utility stock. Number 3. AGNC Investment Corp. Don't worry, I haven't forgotten about you dividend income seekers out there. Should a crash or correction occur, Mortgage Real Estate Investment Trust (REIT), AGNC Investment Corp., and its 9% dividend yield would be ripe for the picking. Mortgage REITs are companies that borrow money at lower short-term rates to buy assets with higher long-term yields, such as mortgage-backed securities. The difference between the yields they receive on their owned assets minus their borrowing rate is known as the net interest margin. Typically, the bond yield curve steepens during the early stages of an economic recovery, which is where we are now. When that happens, it's pretty common for mortgage REITs to see their net interest margin expand. What's more, AGNC Investments' assets portfolio is almost entirely devoted to agency assets, i.e., securities backed by the federal government in the event of a default. Having this added protection allows AGNC to wisely use leverage to its advantage in order to increase its profitability. Number 2. Green Thumb Industries. An important thing we learned about cannabis during the coronavirus pandemic is that it's treated like a basic need consumer good. In other words, people keep buying weed, no matter how well or poor the economy is performing. That means a crash would mark an excellent opportunity to buy US multi-state operator Green Thumb Industries. Green Thumb currently has 59 operating dispensaries and 110 total retail licenses in 13 legalized states. It's been particularly picky about the states it's choosing to operate in and has focused on the states where license issuance is kept by regulators. This will minimize the number of competitors it's up against. The real secret to Green Thumb's success and why it's been able to turn a corner to recurring profitability is the healthy amount of revenue generated from derivatives. Such as vapes, oils, and edibles. Derivatives are far less likely to face oversupply concerns relative to dried cannabis flower, and they produce superior margins. Suffice to say, Green Thumb can show opportunistic investors to green if both during a crash. Number 1. Bristol Myers Squibb. When stock market volatility picks up, putting your money to work in defensive industries and sectors is usually a smart idea. That's why pharmaceutical stock Bristol Myers Squibb would make for the perfect buy. Bristol Myers made one heck of a splash when it acquired cancer and immunology drug developer Celgene in 2019. Celgene's leading cancer drug, Revlimid, has grown sales annually by a double-digit percentage for over a decade, and the company has benefited from a strong pricing power, label expansion opportunities, and longer durations of use. Revlimid brought in more than $12 billion for Bristol Myers last year and is protected from a flood of generics until early 2026. However, Bristol Myers Squibb isn't just relying on acquisitions to get the job done. Eliquis has become an unquestioned global oral anticoagulant therapy of choice, and cancer immunotherapy Opdivo brought in about $7 billion in sales in 2020, with Opdivo being examined in dozens of ongoing clinical trials. Label expansion opportunities offer plenty of promise. This brings us to the end of our video. I hope you enjoyed. Hit like if you did, and don't forget to subscribe to our channel so that you don't miss any of our videos in the future. Also, watch the 2 videos that are in your screen because I'm sure you'll love them. With that, I'll see you in the next video.